Good afternoon, ladies and gentlemen. A very warm welcome to you on Business Today Television and in our special series of Market Gurus. Our guest today is Mr. Jyotivardhan Jaipuria. He's the founder and managing director at Valentis Advisors Private Limited, manages about 1500 crore rupees and has been in the markets for the last 36, 37 years, spent about 21 years with the Bank of America Merrill Lynch, and for the last 9 years he has been running his own fund. Namaste Jaipuria Saab and a very warm welcome to you. Jyoti ji, the pain is obvious in the market. Everybody is spending midnight oil to see what Mr. Trump tweets and then react negatively to the market the very next day. How do you feel at this moment? What should be the strategy going forward and how are you reacting?
So, like if you just step back, Trump had flagged this some time ago that April 2nd tariffs are coming. But I think most people were not expecting this magnitude of tariffs. So, like, we were thinking that India tariffs would be somewhere in the range of 10 to 12%. Because if you really think of average tariffs which India imposes on US import and what US imposes on us, the difference was coming to that range of around 10%. So I think the magnitude of the tariff has been a big surprise for people. Uh, what this probably does is, I think it's inevitable that inflation in the US will go up because no country will absorb this whole tariff. So it will be passed on to the US consumer, and that in turn could lead to a slowdown at best and maybe like a recession. So I think over the next few months, we'll get a lot of noise on stagflation, which will come in the US. So, that's going to be one pain point for the market. The other is what it does to other people. Like, what's the reaction to this action now? And, does every country start imposing tariffs on US? Because then it sets up a trade war, which gets very difficult to control at some point. You don't know where it goes. The third is, and this is like an indirect benefit is, let's say for somebody like China, they were sending goods to US which they are not able to send. Do they start dumping it in other countries in Asia? And we start finding that, okay, suddenly China is flooding us with cheap goods. Now we have to erect tariff barriers against them, or suddenly our growth to slow down. So the risk is that we end up with a much slower global growth than what we were looking at, let's say, a few months ago. And that could be negative for, in general, global markets. And, that's something which people didn't think about, or at least were not building in when we started the year. Everybody was building some slowdown in growth, but this could be much slower than what we were thinking. And finally, what it's doing is disrupting what has been the gains of the last 30. So if you see, WTO came in and it's been 30 years, and what that achieved was a global supply chain issue. And that global supply chain helped bring down inflation on a very structural basis. Now suddenly we are going back on that. So I call it deglobalization is happening. Once that happens, then again we probably get back into a scenario where inflation is going to be high again. Suddenly, that old inflation, when inflation had come down because China produced this cheaper, India produced this cheaper, that reverses. And it was my worry that it would happen after COVID, because I thought COVID made people feel, okay, I don't have medicines in my country I wanted. It didn't happen after that, luckily. But suddenly it's happened when, you thought everything is back to normal.
Uh, Mr. Jaipuria, because you've seen so much of the world and with possibly one of the best FIIs globally, uh, in a very precise manner, do you think Mr. Trump will succeed in doing what he plans out to do? If that is so, what will happen to US markets, and as a corollary, what will happen to Indian markets?
So, now what he's planning to do, and at least, their stated objectives, there could be other objectives, but his whole objective is, I want manufacturing to come back to the US. Now, he's saying that I can make my manufacturing lower cost. So I'm going to increase the prices of all other products. And that's the way it will come back. Most of the time, history is that it doesn't work that way. Because, for somebody today, if he has to take a decision whether he wants to manufacture in the US, so he's to put up a factory, he has to think not 2 years and 3 years, but the next 20 years that, he should be able to make it and sell it in a cheaper way in the US and across the world. Now, these tariffs are something which can get changed. And Trump has said that, other countries come to me and then they negotiate, I will change the tariffs. So then, how does somebody put up a factory today? Because if suddenly this tariff is changed, then that factory again becomes unviable. Second is factories take a long time to come. There's a change in regime. There's a change in, a party which rules and they go back to the old tariffs. Then the factory can't be made unviable. So I think, one issue is going to be that if you want manufacturing to come back to US, the tariffs may not bring those manufacturing back to US. Now, if there could be other objective, which is that I want others to cut down import duty on US goods, that he may succeed in doing to some extent. Because everybody will start weighing what helps them, what does not help them. Like, I guess India started the negotiation a few weeks ago, and they said we'll move to a free trade. So, there'll be a lot of give and take in that negotiation. But obviously, like, India will cut down some tariffs also and give access to US products on some tariff. We'll probably end up buying oil from them. We may buy defense from them. So, to that extent, there'll be country by country negotiation, which he does. So, if he's thinking of this not as like really, I'll bring manufacturing back to US, but basically I'll be able to open up new markets for this. Maybe to some extent he'll succeed. But the last point is going to be, you succeed in the long term, but there's a short term pain. And whether the
Correct.
US consumer is willing to take that pain and who wills first.
Right.
Because at some point, the inflation pain may be more than what, the consumer is willing to tolerate, and approval ratings start to fall for any politician. They don't like it at that point of time.
So we have to survive this, and we have to somehow make money from this turbulence that is affecting our markets. You manage a rising star portfolio, a multi-cap portfolio, all put together 1500 crores. What are you doing against this backdrop of tariffs, plus the backdrop that RBI has loosened liquidity in India, and later next week we have another meeting? What do you think will happen in that meeting, and how do we navigate this volatility?
So, if we like had not looked at the tariffs, there was a lot of things were changing incrementally positive for India. Like, market had come down, so valuations were, even if you don't call it cheap, they had gone to somewhere near fair value range. Liquidity was, like you said, improving a lot, and RBI has done a lot to improve liquidity. So finally, we have a surplus on liquidity. Rates came down like in February. Our view is that rates will come down again in April. Hopefully next week they cut rates again. So, in that sense, things were going in the positive direction. Earnings were awful in the first half of this fiscal year. They picked up a bit, and I think the March quarter numbers will come now, which again will be like not great, but maybe a little bit better than what we saw in the first half of the year. So it was slowly, growth is picking up a bit, even if it's not galloping, it's picking up a bit. So our view was we'll get into a period where we make some money in the market. It may not be anything like we saw in the last few years, but we probably make positive return, and we make return which are maybe, more than debt instruments. Now, these tariffs have created obviously like a bit of question. For us, it is we always just step back and think, okay, so does earnings of this company change dramatically because of this tariff? So we had this one view which we have been playing for the last few years, which was buy local, avoid global, which was, focus on domestic sectors and try and avoid the global sectors. We were, in fact, over the last 1 year, we were saying, okay, that tilt which was very, very pronounced earlier, we were slightly, moderating the tilt because a lot of the domestic sectors had done well. Valuations had gone up, and some of the global sectors, the valuations had come down quite a bit. Again, probably that tilt remains to buy domestic plays rather than to buy global plays. Because the domestic plays, at least on a very fundamental basis, are not affected by these tariffs.
Okay. So, please paint for us a scenario for three sectors which you think will benefit from rising liquidity, plus the fact you mentioned that valuations have corrected substantially, and therefore might have a better second half.
Yeah, so, I guess looking at I guess we are talking FY26 second half, right? Not FY25, because FY25 is more or less done. So, the benefit will come only in the next year. So,
Correct.
what liquidity does. So, first is let's talk of banking and, the BFSI space in general. So, there, what the liquidity does is, so for banks, the worry was that we're not getting deposits. So, once liquidity starts coming in the system, deposit growth will start to pick up. Second is interest rate short term. When interest rates come down, banks actually find a pressure on margin because you get an immediate repricing of your loans. Their rates go down, but deposits take a longer time to reprice, so deposit rates will go down with a lag. So short term, there's a reduction in your net interest margin. But what interest rate does is it boosts the economy. And you know that ultimately my NIMs are going to go up when the cyclical phenomena plays out. So, that again helps the banks. Ultimately, it is like if the economy does well, then the banks start to do well because credit growth picks up. Second is your NPL scenario starts to get poor. And when we look at valuation, banks are in a sweet spot because it's
Yes.
probably the only sector which is trading at less than 10-year average valuations. Otherwise, everything in India still trades at premium, like, valuations have become better, but they're not exactly cheap even today. They're still, and it's true across the world also, valuations are not cheap anywhere. So banks are like, very, very reasonable on valuation. So that's one sector which straight away does very, very well. The second sector which probably does well is, cement. So cement is partly linked to the fact that over the last few years, we've seen a lot of consolidation in the sector. So the big two have, taken over many of the smaller companies. Uh, there was a bit of pressure as this consolidation was going on because, at that point, you don't want cement prices to go up because you want to buy some of these smaller players cheaper. So you're okay with cement prices not really going up. But now I think we reached a stage where, if you think of telecom, the same thing happened in telecom. Once you became like two and a half players there, then tariffs started to go up. So we think from here, cement prices are probably going to go up now. And, demand will pick up because if you get liquidity, you get government spending coming back. And so, the demand scenario looks good. Capacity adds are going to be lesser than what your demand pickup is going to be. So, in that sense, utilization levels will go up. And in any sector which is more consolidated, pricing power is always there for the taking. So, last few months, we've seen cement prices hold up. Last 18 months, the scenario was cement prices would increase at the beginning of a month, and by the
And
middle
then
of the
come
month,
down.
it would be rolled back again. So now finally we are seeing cement prices hold up. And again, this is a sector which is totally immune from global. So you can't get cement into the country. You don't export much, you don't import much. So it's a very, very domestic sector. So, tariff wars are going to hurt it relatively much lesser than what we've seen in some of the other sectors. Now, the third sector would be to some extent consumer, and I'm talking of consumer in a very general way and not staples, because one is this year we're getting into the benefit of the tax break. So that 1 lakh crores of tax break which is coming to us, that is helping us. Second is in terms of consumer buying, uh, interest rates will start to come down. So for any consumer debt which you take, you'll probably start having lower interest rates, so it gets easier to service the EMI. So in general, the consumer sector will probably start to do a little better. Uh, we don't like the valuations in most of the consumer space. So it's a little challenge to find stocks which we think are adequately priced where we can make money on the valuation space. I think the staples is what will not really benefit too much. So staples is what we are avoiding out of that. So we tend to buy stuff in the consumer discretionary space more than in the consumer staple space. But even discretionary, not very cheap. In fact, what we tend to have there is more ancillaries to the larger players, people who supply some material to, let's say the white good manufacturers, or stuff
Okay.
like which benefit from Indian spending more on travel and
Okay.
tourism. So, those are the sectors which we really play over there.
Okay, this is a wonderful answer. BFSI, cement, and consumer discretionary. Mr. Jaipuria, I forgot to ask how much of this 1500 crore rupees is invested in number of stocks?
So there would be roughly 30 odd stocks which we would have
Okay.
between the two schemes. We've done two schemes there. So there
Fair.
will be 30, 35
And
stocks.
this is a very, very concentrated portfolio. I mean, it's a focused portfolio, so to say. How
Yeah.
many of these are large caps in terms of valuations? You watch valuations very, very closely. What would be the average PE of the overall portfolio?
So, if we look at the P of, and I'm looking at two separate portfolios. So one is the Rising Star, which is largely a small cap, mid cap portfolio. So there are no real large caps over there. That trades at a valuation of 15 and a half time 1 year forward. So we've tried to keep like, we are very, very focused on valuation.
Yes.
IT cap trades at a valuation of around 19 time 1 year forward because the large caps they trade at decent valuation. So our effort always is we are very valuation conscious. So
Yes.
we want to buy growth at a very reasonable price.
Okay. That somehow this explains what you're thinking at this point of time. Uh, how about the broader market, Mr. Jaipuria? You are focused on 30, but large parts of the market you think have come down in terms of valuation comfort, or is there still large pockets of fluff, large pockets of how should I say overvaluation in the market? What sectors are you avoiding completely?
So it's market is not cheap. So it's better than what it was, let's say at the beginning of the year. At the same time, we can't call this like valuations are mouth-watering where you can just buy and make a lot of money on it. So a lot of companies are priced very very fairly, and they are linked to some sort of strong growth coming. So if that growth starts to disappoint, then you can see a lot of downside in the stock prices. So if you look at let's say the railway type of stocks or the defense type of stocks, you possibly have a good visibility that growth will be there. But they're priced to perfection also. So in case growth slips for whatever reason, then the valuations can contract very, very quickly. So for us, we like, don't end up buying stocks over there. Though we love the sector, we think over 5 years it will become much bigger in terms of sales and in terms of order book. Because we don't find valuation very attractive at that stage. We think the what we look for always is margin of safety. That if things go wrong, then how much can we lose money, and we don't want to lose too much money. So that we don't find in some of these sectors. Ironically, like I said, though I like consumer, I still don't find like consumer staples as a very attractive space to buy. So it just
जयपुरिया
becomes
साहब, हाँ हाँ,
sorry.
ज्योति जी वो तो कभी वैल्यूएशन कंफर्ट आया ही नहीं, लीवर, नेस्ले, आईटीसी, मतलब
Yeah.
25 साल तो मेरे को ही हो गए देखे देखे, कभी भी सस्ते नहीं हुए। टाइम करेक्शन होता है, ना प्राइस करेक्शन हुआ ना वैल्यूएशन करेक्शन हुआ। चलिए वो बात रहने देते हैं। अब बताइए ये आईटी में क्या हो रहा है? ऑन द इंडेक्स इटसेल्फ वी हैव 27-28% correction from its most recent peak of 46,000. Is the Indian IT story over?
So see, I don't want to say it's over or not over, but yeah, it's not going to grow the way it used to grow. So that is a very easy answer. We've avoided it for a long time now. And part of the reason we avoided, and I think I said it on a couple of earlier shows also, was that, at some point it had underperformed a lot. But our view is that just structurally, because of artificial intelligence, I think the number of people required is going to come down. So that's why the growth prospects are no longer what they used to be. So there'll be some gain coming from them because they'll get, AI related work, which probably will be hopefully higher margin. But just a sheer number that the volume required is going to keep shrinking because AI is going to take away a lot of these jobs. So that was one reason we've been avoiding IT and we've been underweighted. I think for last 5 years or something, we've been underweight IT. Now, of course, what's happened with this Trump tariff is, like I said at the beginning, we think there'll be possibly a slowdown and people will start talking about recession in US. That is never good for IT because ultimately you depend on companies and the economy in US doing well for IT to have a visibility on their growth prospects. So I think IT growth prospects are clouded near term, and that's the reason it will be very difficult to buy it. Most companies will come with their guidance now over the next few weeks, And I think it will be like a bit of cloudy guidance where visibility is not that high.
When you refer to margin of safety in your previous answer, apart from BFSI, cement, and to some extent consumer discretionary, where else do you see margin of safety?
So, to some extent, it's not like we always have margin for safety, but then we think that the earnings visibility is good enough to drive the growth. So we are
Okay.
betting on earnings at some point coming. So there are some sectors where, we think that those, because of, let's say, capacity increase they've done, and they are able to pick up demand is there, or they are substituting some import item. We think there's a lot of growth visibility which will come, which will drive earnings. So a lot of them tend to be, in some ancillaries to either the auto companies where they're expanding their market size, or it is, ancillaries to some consumer companies. And that's where, as long as there's an expansion of the addressable market, then you think that the growth can.
Therefore, return will be a byproduct, or are you gunning for very, very, strong growth in maybe some pockets and betting big on those? What is the broader thought that is going in your mind?
So, like I said, now, this year we should not expect return like what we saw over the last few years. So,
ठीक है.
the way we define it is we are now playing a test match. We played a T20, though IPL season is going on in stock market, we are playing a test match now. And in a test match, when the ball is seaming all over the place, you have to defend. So defense is also one action, and it's not like a non-action. So at the moment, you have to defend. There are a lot of moving parts all over. At, now the tweets at night are becoming more important than probably the fundamentals in the day. So we just have to keep defending it, and this will pass also. As we know, slowly this will pass and things will improve.
So, margin of safety is in large caps by and large. It is in domestics, and it is not in sectors which are looking at global markets or global economy, right?
Yeah, because of just this, the way tariffs are going,
Yeah.
we don't know how much tariffs will change. It's like, because Trump has said we'll negotiate. So today,
Huh.
let's say India is at 26 and some of the competing countries are much higher tariff. We feel very good. But suddenly negotiation, somebody comes down from 35 to 15, then
Huh.
we say, oh God, we got hurt now. Now we need to bring ours down to 15. So it is going to be over the next few months, there'll be a lot of moving parts which will happen there. So we need to be careful on either side and really, keep watching what is happening.
So there are going to be outswingers, and there's also going to be a reverse swing. We'll keep that in mind. And my final question to you, Mr. Jaipuria, is I do not know whether Valentis has a process to keep gold as a part of its portfolio in Rising Star and Multicap. But how do you see gold in this time of reverse and outswing?
So we don't buy gold. Like ours is a pure equity house, so we're not a multi-asset. So we can't buy gold itself in the portfolio. And so obviously, see, gold is like what people buying safety. At the same time, what we to remember is gold have done very well. So it's
Yes.
not like people woke up now. Last 1 year, people have been trying to buy safety, so they've done well. So just the sheer performance of gold means like you have to be a little careful and you have to start thinking that, okay, if some of this uncertainty goes away over the next few months and tariff, or not just tariff policy making in the US stabilizes,
Yeah.
then suddenly you may find that gold is no longer looking as attractive.
Okay, 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 fine. Mr. Jaipuria, what a wonderful 25 minutes and margin of safety, something that we've studied in books and seen one of the best practitioners move a large part of his portfolio to cash is something central to your investment thesis. And of course, a test match, swinging markets, and safety in perhaps private sector banks, cement, and 35 years in the markets, and is now navigating the next 6 months to 1 year with intense caution. He believes that we are now playing a test match and the ball is swinging on both sides, outswinging, in swinging, and reverse swing as well. policy making at the moment is very, very volatile, and one really does not know what happens. Therefore, stick to the principle of margin of safety, and within margin of safety he finds the BFSI space attractive. Cement post consolidation and post decent consolidation in the price of the product looks positive, and of course, some value can be found in consumer discretionary, which is the ancillaries that supply to large brown goods makers. That, ladies and gentlemen, was Mr. Jaipuria's thoughts. I hope you have benefited from his views just as we have. Thank you so much for watching. There's a lot that's happening on the other side of the break. Please continue with Business Today Television.
Starting tomorrow, the United States will implement reciprocal tariffs on other nations